It's that time again, the start of a new month where we take a look at a few high-quality dividend-paying stocks that look worthy of a buy. This task has proven to be a little bit more difficult of late, as market valuations have been quite elevated. But like I always say, there always is a deal somewhere. As such, in today's video, we're going to take a look at 3 high-quality dividend-paying stocks that look worthy of a buy. And before we begin, do me a huge favor. Click that like button down below. Show your appreciation. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their top 10 stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 cheap dividend stocks for the month of April 2024. Beginning with dividend stock number 1, which is Agree Realty, stock ticker ADC. Agree Realty is a real estate investment trust, also known as a REIT. It came public in 1994, the same exact time that Realty Income, the most popular REIT on the market today, came a public company. As we take a closer look here in a second at Agree Realty, you'll see that there's a lot of similarities between both of these companies. Similarities in tenants, similarities in property types, but I believe Agree Realty, at least in the near term, has a lot more upside. Taking a look here, you can see that Agree Realty has a market cap of $6 billion, so much smaller in terms of size compared to Realty Income. And over the past 12 months, REITs have been hammered with high interest rates. So therefore, Agree Realty, it's no surprise that the stock is down 16% over the past year. For those of you unaware, Agree Realty is a retail REIT. So a lot of the top tenants that you're going to see on the list here in a second are probably tenants that you frequent or pass by on a regular basis. As you can see here, Agree Realty has over 2,100 properties with 69.1% of their rent coming from investment grade quality tenants. But that number is actually much higher considering the high quality tenants they have that are not rated companies, but would meet investment grade quality if so. Some of those top tenants include notable names such as Walmart, Tractor Supply, TJ Maxx, Lowe's, Hobby Lobby, and the Home Depot. The top 10 tenants account for 37% of annual-based rent. In terms of sectors, grocery stores, home improvement, and auto service locations are the largest 3. So what makes Agree Realty so intriguing? Well, one of them is the quality of the tenants that they have, especially those at the top of their list. Also, though, is their growth potential, which over the past 5 years has been outpacing its peers. In addition to the growth potential, they also pay a solid dividend. The company pays an annual dividend of $2.96 per share, which equates to a high dividend yield of 5.2%, to go along with a 5-year dividend growth rate of roughly 6%. Now in terms of valuation, talking a little more about that growth, where analysts are expecting the REIT to generate a FFO of $4.10 per share in the next 12 months. That gives the company a forward price to AFFO of 13.9 times, well below the company's 5-year historical average of 19.9 times. So let's say that the 5-year average is too high, and the REIT is only worth, say, 17 times multiple. That still puts a price target for the stock closer to $70 per share, implying more than 20% upside from current levels. And that brings us to dividend stock number 2, which is Abbott Labs, stock ticker ABT. Abbott Labs is probably better known as the company that spun off AbbVie, stock ticker ABBV, which happens to be one of my favorite dividend stocks and one of my longest held positions. Abbott Labs did this back at the end of 2012, which then AbbVie started trading on its own at the start of 2013. Abbott Labs maintains a solid balance sheet with a credit rating of AA-, and they have maintained a low debt to equity, showing the strength of this healthcare company. Abbott Labs currently has a market cap of $194 billion, and over the past 12 months, the stock is up 10%. Abbott Labs was one of those companies that was involved during the pandemic, as they created many of those testing strips that you may or may not have used during those pandemic times. But since then, a lot of those pandemic-related sales have fallen off. However, in their latest report, we saw that organic revenues actually increased 12% year over year. The company's largest segment, which is medical devices, increased 17.5% year over year, speaking to the solid and sound results the company has been reporting and is expected to report moving forward. In terms of the dividend, the company yields a dividend of 2%, and they have a 5-year dividend growth rate of 12%. In addition, we are talking about a dividend king, as this company has increased their dividend for 52 consecutive years. Now for valuation, where analysts are expecting the company to generate EPS of $4.60 per share, which equates to a forward PE multiple of 24.4 times, which is below the company's 5-year historical average of 26.2 times. Now the stock trades at a slight discount, but that's based off 2024 EPS, whereas the 2 years beyond, the EPS growth, as you can see, is expected to pick back up to double digits, making the stock look even cheaper. And that leads us to dividend stock number 3, which is Vici Properties, stock ticker VICI. Vici Properties is a REIT, and if you've watched and tuned into my Dividend Power Hour, or maybe you're a premium subscriber to The Investor's Edge, my weekly newsletter where you can see my entire portfolio, all my buys and sells, then you probably know that Vici is my largest REIT holding. And if you're interested in seeing my entire dividend portfolio, my entire portfolio as a whole, you can check out the Dividend Investor's Edge. There's a link down in the description below. You'll get monthly portfolio updates, all my stock buys and sells, weekly stock deep dives, my top watch list as well, and so much more. Check out the link down in the description below. Now back to Vici, where Vici happens to be the largest landlord on the Las Vegas Strip. The company currently trades at a market cap of $31 billion. And over the past 12 months, as I mentioned with Agree Realty, REITs have been a sector that's hit pretty hard, and the stock is down nearly 10%. As I mentioned, Vici Properties is the largest landlord on the Las Vegas Strip, but that's just one piece of the business. They have hospitality casino properties all around the US, but obviously Las Vegas is a key component, as they own attractive properties such as Caesars Palace, Mandalay Bay, the Mirage, New York, and the list goes on. What intrigues me most about Vici Properties? Well, first and foremost, the high-quality premier hospitality portfolio. They work with the top operators in the entire industry. They have strong and stable cash flows, one of the only companies that maintained a 100% cash collection rate during the pandemic, and they have done so ever since the company has been formed. Oh, and by the way, they pay a solid growing dividend. Speaking of that dividend, the company currently pays the dividend of $1.66 per share. That yields a dividend of 5.6%, the highest on today's list, to go along with a 5-year dividend growth rate of roughly 8%. This company has grown its dividend every single year it has been public. In terms of valuation, analysts are expecting the company to generate AFFO of $2.25 per share in 2024, which equates to a forward price to AFFO of 13.1 times, well below the company's historical average of 16.3 times. So if the stock were to get back just to its average valuation, which is where I believe it should be trading at a minimum, we are talking about a price target of $36 per share, implying over 20% upside from current levels. So there, folks, we just went through 3 high-quality dividend stocks that all appear cheap. Great buys for you to consider during the month of April. Down in the comments section below, let me know which of these 3 stocks that we covered today is your favorite. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.